Welcome to Market Catalyst. I'm Jared Blickery. We are 30 minutes into the U.S. trading day, and let's get to the three market catalysts that we are watching this hour. First up, Apple gears up for its biggest event of the full year, full coverage ahead. Plus, jobs revision data due out in moments' time. We're going to break down the state of the labor market. And then we go to the Goldman Sachs Tech Conference in San Francisco for an interview with the CEO of CrowdStrike. Now, let's get a check of the markets here. And we'll start with the major averages. We can see the Dow just barely in positive territory. We just got that revision number from the BLS, which we're going to break down in a few minutes. It was 911,000 jobs lost versus an expectation of 682,000, so a little bit worse than expected. But we're seeing the Dow just very kind of flat today, trading around the unchanged line, or the unch as we call it. Here's the NASDAQ, also very choppy action. You can see it's been positive all day, up about 10, 11 basis points. And the S&P 500 barely positive, and just a kind of similar story right there. And let's move on over to the bond market, where we have the 10-year T-note yield. That is in a reversal of the prior day's trend, and also the trend we've seen for the last few weeks, which has been down. Slight bounce today. It's up 1 basis point to 4.06%. And here's the 30-year yield. That is up 3 basis points to 4.72%. But if you take a look at the 1-month chart, you can see definitely in a downtrend right there. And let's skip on over to the sector action and see who's leading. Energy has been the standout all day. That's up 1.8%, as crude oil is also bouncing today. That's a reversal from yesterday. Financials up, utilities, both of those up about 0.4%. Finally, healthcare. Those four round out the outperformers of the S&P 500. And then to the downside, we got materials, industrials, consumer discretionary. Those are the three biggest losers of the day. Those are cyclical sectors. So what we're seeing is a little bit of value in play here and a little bit of a defensive leading the way in the early goings. Now here's the NASDAQ 100, and we're going to be talking a lot about Apple today. That stock is down 0.6%, maybe a little sell the news there, but it has been trending up nicely since we got that April 9th liftoff. And you can see a little bit more red than green here. I'll also mention Meta, that's up about 1%, and Broadcom down just about 0.6%. And if we take a look inside the Dow, kind of a mixed board here. And if we sort by performance, we can see the leader there, United Health. There's another healthcare play, followed by CVX. That is Chevron. That's up 1.5%. So healthcare and energy, kind of the stories of the day so far. Sherwin-Williams pulling up the lead, or up the rear there, down about 2.28%. And Apple's biggest product launch event of the year is happening today. The company expected to release its new iPhone lineup, new smartwatches, and more. Joining me now is Yahoo Finance tech editor Dan Howley and Bob O'Donnell, technologist research president. And Dan, let's start with you. What are the biggest things you're watching today?
Yeah, Jared, there's a few things that are going to stand out here. Namely, at the top would probably be the so-called iPhone 17 Air. That's supposed to be the thinner iPhone, a complete redesign, the first one that we've seen since the iPhone 10 back in 2017. And that's supposed to be thinner overall compared to the standard iPhone or the Pro iPhones. But it's also supposed to have just one camera and a smaller battery. So those could be potential turnoffs. It's also seen as kind of a precursor to what could be a foldable iPhone next year. In addition to that, obviously we'll see upgrades to the 17, the standard 17, as well as the 17 Pro and Pro Max. They'll also get, obviously, Apple's iOS 26. That's the latest version of the software that powers the iPhone. And then we're also looking at potentially new Apple Watches, the Series 11 and the Ultra 3, and new AirPods, the AirPods 3, with heart rate tracking technology built in. Now, Apple's Beats brand already has earbuds that do that, so this would just be kind of moving that technology over to the AirPods. And then, obviously, one of the bigger questions is pricing. Some analysts on Wall Street expect between a $50 to $100 price increase, depending on model. We'll have to see if that's a turnoff for consumers, or if they're just willing to swallow it if they're on those subsidized plans. So obviously, some big announcements coming, but that Air is going to be the biggest.
Yeah, thank you for that, Dan. And let's bring in Bob. Bob, you and I have talked about Apple on the Stocks and Translation podcast at length. We just got a few minutes here, but first of all, what do you think about the importance of this cycle right here, this announcement date, and how does the upgrade cycle fit in here? Is it going to move the needle for people who are thinking about spending some money, especially before the holidays here, on that next upgrade phone?
Well, thanks, Jared, for having me. And look, and like Dan pointed out, today's really going to be about hardware more than anything. And I think that's important to remember because we've had a lot of discussions about, Apple Intelligence and what Apple's doing in AI and are they behind and does it matter? I think the point I'm guessing we'll hear Apple Intelligence today, but likely all the focus is going to be on those new hardware designs, that iPhone Air. Look, it's been a sea of sameness in the iPhone for the last, like since the iPhone 10, I think
Yes.
Dan said, and so people are looking for something different. So this rumored iPhone Air, if it proves to be something interesting, the question is, what would the compromises be? What will the price point be? But I think some people are just going to be eager to have something different, frankly. And so that'll be interesting to watch. The other stuff, we're going to see the normal things as my guess, right? It's always a little bit better camera. It's a little bit better processor, all those kinds of things. With the watch, we'll see what happens. But, rumors are flying on exactly what Dan said, which is, upgrades across the board. If, in fact, they bring heart rate tracking onto the AirPods, I think that's interesting because AirPods are purchased by a lot more people. And it's interestingly enough, a lot of people have said for years that actually the ears are a better place to do heart rate tracking, even though it doesn't seem intuitive. But that's actually medically the case. And so the result could be even more accurate health data, which I think is going to be important, because Apple has clearly positioned these products as health-based accessories.
Yeah, I want to expand on some of the new features that might be coming out. What are some of the potential surprises here? Because I was reading recently that the AirPods could have tracking that would enable them to make real-time translations. And this seems some Star Trek stuff to me, but hearing a conversation in another language and then providing the audio translation in the ear, anything like that might really move the needle and come a little bit sooner than expected.
Well, I think, there have been rumors of that, like you said. Google showed some similar types of technologies. It would certainly be interesting. At the end of the day, the question is whether they do it or not, how good is it, right? That's the other thing. It's like, it's one thing to say it's there, but how effective is it, will determine how important it is. And, again, I'm not sure it's going to move the needle. I think people who are looking to upgrade will be happy to get some of these capabilities, but I don't know that it really drives a super cycle or any of those types of things.
All right, Dan, I want to bring you back in here. Any thoughts on what we've been talking about so far?
Yeah, I just want to say, and Bob kind of pointed this about, AI and, the will they, won't they kind of rollout here. They've clearly been behind Apple. As Bob said, they have, Google has real-time translation. They've been pointing that out with their new Pixel 10 line. But those aren't going to be volume sellers. It's really the Samsung phones that are the biggest Google sellers in the US. But it will be interesting to see what happens on the AI side with Apple, just because of the debate on, what it means going forward. I still think that at this point, most consumers are looking at, AI as kind of a nice to have, but not need to have. And the hardware is still the main go-to. But when it comes to this AI over time, Apple's going to have to really start to amp up what it has to offer to match what's available for Google. And that'll all come down to when Siri comes out potentially next year.
Bob, I want to ask a question about what investors should be looking forward to today. What's going to move the needle for them? Because as I mentioned, the stock is down right now, and I've observed this in years past. It tends to be a sell the news event. You get a nice rally into it, and then there's a little bit of a disappointment. What could get investors excited about Apple stock today?
Well, it's a great point, Jared. I mean, it's tough. I'm not convinced. I mean, who knows? Look, there's always the possibility with an Apple event of one more thing, right? So maybe they bring out something that we don't know about. That would certainly get people pumped. But if it follows the script that, that Dan suggested, that, the rumor mills are talking about, I don't know. It'll be interesting. If we dive into the details, one of the more interesting rumors is that Apple is going to have more custom silicon. So what does that mean, right? How does that play into what they're doing moving forward? That will be an interesting detail to watch to see if, in fact, they have more custom silicon they bring to the equation. So, I mean, there's a lot of little things. Maybe there's additional services that Apple's going to bring into the play. Because remember, services is a huge part of the business. I mean, I think today is going to be mostly focused on the hardware, but Apple always manages to throw in a couple other little things along with the story on the hardware side that could, pique people's interest. But realistically, I'm not necessarily sure we're going to see anything dramatic again, unless we get that surprise at the end.
Yep, but we want to follow all these details, and we will be doing that throughout the day here on Yahoo Finance. Thank you, Dan and Bob. And we have all your markets action ahead. Stay tuned. You're watching Market Catalyst. The Bureau of Labor Statistics revised the nation's job growth lower by 911,000 for the 12 months ending March of this year. That's a much deeper than expectations of 682,000, and this was expected by analysts before the report. And for a look now at what this means in the broader economic context, I am joined by Gus Fouché. He is a PNC Financial Services Group Chief Economist. So we're talking about something that's kind of wonky here. It moved the market a little bit, but we're talking about revisions to a BLS data set that affect things that is kind of rearward facing here, going all the way back to March. But this is very important because data integrity is front and central in people's minds here. Just lay out what is happening here today and maybe give us a little bit of context.
Sure. So the Bureau of Labor Statistics, the monthly employment data is based on surveys of employers that the BLS sends out, but then they adjust that for unemployment insurance data, which is much more complete, which covers the entire universe of employers. So every year, the Bureau of Labor Statistics goes back, they look at unemployment insurance data, and they use that to benchmark the employment data. And what this data shows is that employment in March of 2025 was lower by about 900,000 compared to what the BLS had previously estimated. That means job growth from the period of March of 2024 to March of 2025, was significantly lower, slower than we thought, and the labor market isn't quite as strong as we thought it was before these revisions.
So two questions here. How much does this impact the thinking at the Fed, which is meeting next week and has to decide on interest rate policy? And then what would you say to address some of the headlines and stories that are inevitably going to come out of this, that labor market was actually much weaker than we expected, and there might be some conspiracy theories thrown in there? How do you account for this, and how do you think about this?
So the first thing in terms of the Fed, first of all, these revisions are only valid as of March of this year. So they don't necessarily tell us anything about the job market in August and September. But what they do indicate is that, in the second half of 2024 and early 2025, job growth wasn't as strong as we thought, certainly not as strong as the Fed thought. And so that suggests that interest rates perhaps are too high and that the Fed may need to cut interest rates in the near term in order to support the labor market. In terms of the integrity of the data, this is a data integrity effort. The BLS is incorporating as completed data as they can get to make sure that the numbers are more accurate. If we were to try to include these unemployment insurance numbers every month, that would delay the data tremendously, and that would make it much less useful for the Fed. It's very important for the Fed, for economists, for business people to have access to timely monthly employment data, and then when we can, to go back and do these revisions based on the more complete unemployment insurance data. I think the overall story hasn't really changed that much, which is we had a very strong labor market in 2023. We had slower job growth in 2024, and then we've seen an even more significant slowing in job growth this year, suggesting that, the economy is just adding, 20,000, 30,000, 40,000 jobs per month in recent months, and that's much slower than what we've seen over the past couple of years.
And I want to build on what you were just talking about. Since the pandemic, the government the BLS in particular sends out these surveys to households and businesses, but response rates cratered, and then they haven't rebounded to where they were before the pandemic. So how reliable are the current figures that we're getting in? And does it warrant any kind of discussion about how we could improve those numbers?
There's no question that revisions recently, and particularly in recent months, have been larger than what we have seen historically. We had enormous revisions coming out of the pandemic, then things settled down, they picked up again in 2025. And certainly that makes it more difficult for the Fed. It makes it more difficult for me and other economists to try to forecast when we see big upward or downward revisions to job growth of 50,000 per month, 75,000 per month. We can invest in the Bureau of Labor Statistics so that they can come up with more accurate ways to get data from employers. We can come up with ways to get employers to respond more quickly to the data. This is perhaps the most important data that we get on the state of the economy. Again, it's very timely. We get it in the first week of the month for the preceding month, so it's a very good indication, and the Fed depends enormously on it. So we should be thinking about ways to fund the Bureau of Labor Statistics so that they can improve response rates, perhaps incorporate this unemployment insurance data more quickly. And so we need to think about ways to make sure that they are fully funded and staffed.
We got about 30 seconds. Any expectations for CPI ahead of this big Fed meeting that we have next week?
I expect to see a 0.3% increase in both core and overall CPI for August. Inflation is starting to pick up as businesses pass higher tariff costs along to their customers, and that's going to be the story throughout the rest of 2025.
All right, that was very helpful, Gus. Very appreciative of your insights there. All your markets action is ahead. Stay tuned. You are watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke Tamama. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. I'm watching shares of Dick's Sporting Goods, Hyatt Hotels, and Madison Square Garden Sports. All three stocks received upbeat marks over at Citi this morning. Let's start with Dick's Sporting Goods. That got an upgrade from Citi from neutral to buy. The firm called the combination of Dick's and Foot Locker, which closed on Monday, that deal, a powerful force in the world of athletic and footwear and apparel. The analyst said that combined, it has potential to be a category killer thanks to its buying power with the largest and most sought-after brands in athletics. Think brands like Hoka, On, New Balance. The Citi analyst also raised his price target from $225 to $280. And Hyatt Hotels also got an upgrade from Citi from neutral to buy as well. Analyst there, Nick Joseph, said factors that could drive share appreciation include outsized net rooms growth in the mid to high single digits, driven by international markets. He also said a concentration in the higher end of the market, including those strong position in the all-inclusive space. Well, that's likely to be a positive in the current economic environment. And the last stock here was Madison Square Garden Sports. Well, the firm initiated coverage of that stock with a buy and $285 price target. Right now, you could see shares are hovering around $206, $205. In the note, he cited that his NBA and NHL team evaluations set records. MSG looks undervalued. It owns both the NBA's New York Knicks. It also owns NHL's New York Rangers. He added that the stock currently trades at a roughly 55% discount, according to third-party valuations from Forbes. He called the valuation gap a buying opportunity. Now, the stock has 5 buys, 3 holds, and 0 sells on the street, but it is moving the most out of our 3 top calls today. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Novartis, Anglo American, and CoreWeave. First up is Novartis. They agreed to acquire Tourmaline Bio in a deal that values the New York-based biopharmaceutical company at about $1.4 billion. Tourmaline Bio is developing a promising treatment to reduce systemic inflammation, a major driver of cardiovascular disease. Next up, we have Anglo American agreeing to buy Teck Resources in what will create a $50 billion mining company. The deal gives Anglo access to Teck's much coveted portfolio of copper mines after a period when it itself has been an acquisition target and has faced pressure from its shareholders. And finally, we have CoreWeave. The cloud infrastructure company, which was one of the hottest IPOs of the year, launched a venture fund to invest in artificial intelligence startups. Its newly announced CoreWeave Ventures Fund will offer founders an array of capital investment models, provide access to the CoreWeave cloud platform, and also give insights on product and go-to-market strategies based on CoreWeave's existing partnerships. CoreWeave, considered the largest publicly traded neo-cloud name, offers cloud computing services specifically for AI workloads, such as providing NVIDIA GPUs and high-performance storage to companies. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. And let's send it over now to the Goldman Sachs Tech and Communacopia conference over in San Francisco, where Yahoo Finance executive editor Brian Sozzi is now standing by.
All right, thanks so much, Jared. Appreciate it, as always. Here with me is CrowdStrike CEO and founder George Kurtz. George, good to see you.
Great to be here.
It's been a while. Thanks for coming on here. Look, every conversation I've had here at this conference over the past day, AI and agents. How are agents impacting what you do in cybersecurity?
Well, if we think about AI and we believe it's the next industrial revolution, you have to have security. And this is something I've said for a long time, is that security parallels the slope of the technology innovation curve. So with all these AI agents, essentially what are they? They're superhumans, right? They have access to data, they have access to compute, they have access to workflows, and they have access to systems outside the corporate network. All of that needs security. And that's what CrowdStrike does. Not only have we protected the humans and their systems for over 14 years, but now protecting all these AI agents and the proliferation of these agents as they cross the corporate network as well as external boundaries. So it's a massive opportunity, and certainly they're going to need security and compliance.
Opportunity for CrowdStrike, but it has to be almost terrifying for enterprise companies. They've unleashed agents inside their operations. I mean, they're trying to grow their business, but still, wow, I mean, there could be some real risks here.
I think there's opportunities, but there's real risks. It's almost like giving full access to an intern and letting them run wild, right? Most people wouldn't do that, right? So you got to put guardrails around them. They can be very productive. And really where the industry is going, I think just in general with AI, is that the humans will manage a fleet of AI agents doing whatever task they're designed to do. But you're going to have to instrument them, right? If something goes awry, you're going to have to be able to roll it back and figure out what actually happened, so you need visibility. And you're going to need data protection, because we've seen so many times where these models are giving up information, prompt injection, which will allow the attacker to get information they shouldn't have.
Last time we heard from CrowdStrike a couple weeks ago, reported earnings, the guidance was in focus. The street didn't seem to like it, but I'm listening to you now. Has your business accelerated?
It has accelerated. And the thing is, when you look at the guidance, which was in line with what we talked about, there's still some impact to partner rebates, which we talked about happened this year, right? So
is that from the outage?
That's from the outage, yeah. So essentially what we had to do is we had to compensate partners for some of the free products we gave away. Well, that's actually a contra revenue line item. It's just an accounting function. You actually have to deduct it from revenue. So it's more of an artifact of an accounting deduction as a contra item than anything else. You have to look at the net new ARR, which reaccelerated this quarter, 221, record for Q2. And then our CFO talked about 40% acceleration in the back half of the year. That's the most important number.
Now that these credits have rolled off, are customers staying with CrowdStrike?
Absolutely, 97% retention. They roll off in the back half of the year. So I think we've done a good job with that. We've strengthened our customer relationships. And at the end of the day, people love our technology, they love our platform, and we're solving a really hard problem for them, which is stopping the breach.
You said one thing in your earnings call that frankly scared the hell out of me, and I wanted to bring it to light. You said adversaries are democratizing destruction at mass scale.
Yeah.
Explain that to us.
Well, the way we look at adversaries, just in a simple way to visualize it, is a pyramid. Okay, and the top of the pyramid is the very sophisticated, and the bottom of the pyramid is less sophisticated. So top of the pyramid, nation state, middle of the pyramid, e-crime, bottom of the pyramid is hacktivism, right? So top, highly sophisticated, bottom, a little less. So when we think about that and we look at AI is minting more adversaries, and they can be less sophisticated. I mean, think about what happens today. If you take any of the technologies, you can turn anyone who can use PowerPoint into a programmer, essentially, right? So if you look at what's happening in the AI world, you're now using AI to create more adversaries with higher level of sophistication that only the top part of that pyramid had. In fact, we've actually identified and found malware that uses any of the number of public GPTs to actually query, figure out what system it's on, figure out what it's doing, and then write scripts to actually go out and pull data back based upon each system it's on. So each system is unique based upon the results and instructions it gets back from the GPTs.
What countries are proliferating this type of technology or trying to attack us?
Well, certainly you have the big ones that are out there. You've got China, you got North Korea, you have Russia, and others that are out there. But there's so many countries that have nation-state capabilities that are very, very effective, that not only are they gathering information for intelligence purposes, but they're also stealing IP. Like China is one of the big offenders.
Is AI then really good for companies? I'm just listening to these risks, and I get the benefits, but wow.
I think it is, because you have to think about AI. So something at CrowdStrike we focused on was using AI for security. When I started the company, it was machine learning, but that was the basis of the company. Now you have also securing AI, right? So one is AI for security, another one is securing AI. So when we think about how we're leveraging AI, something like Charlotte was up 85% quarter over quarter, and that is our technology that essentially allows a SOC analyst to have an automated a partner, if you will, right? They can do a lot of the alert triage, a lot of the heavy lifting of identifying and figuring out like these small little nuances of, there's an indicator here or there, can put that whole picture together, and something that might take days of research can be done in an hour. It can write a report. It has all the latest and greatest intelligence of CrowdStrike. So you have to leverage Gen AI to be able to identify and contain these attacks as quickly as possible.
Can the cybersecurity stay one step or several steps ahead of these bad actors?
I think we can, and it's really the power of the data and the power of the crowd. Part of the crowd and the CrowdStrike is the crowdsourced element of it. And when you look at what we've done with things like Falcon Complete, which is our managed detection and response service, or our intelligence group, we're at the forefront of all these attacks. So, and we've annotated all these attacks and helped identify and prevent these for the last 10 years in production. And that has really become the Reddit of security data. Think about it. What powers these LLMs? Kind of like Reddit, right? You need the right information. So we know the attack path, we know the tradecraft. These have all been identified, curated, and labeled, and this is the basis for Charlotte, and this is why we've got such good efficacy.
Another theme here on the ground at this conference that I've picked up on is this the war for top AI talent. It's a thing, and it's becoming even costlier to get the talent you need. What has been like battling for talent out there?
It's a battle, for sure. When you look at all of the top companies and what people are paying and how people are being recruited, it's a battle. We've got, I think, a fantastic data science team, and a lot of times what we found, pay is very important, of course, right? But it's the mission that we're on, right? I always say we don't have a mission statement, we're on a mission, right? It's good versus bad, it's the oldest story of time, right? And we have people that are focused on the mission of stopping the bad guys and doing harm to our customers, and that means a lot.
As someone that has seen a lot of cycles, I mean, you founded CrowdStrike, is what we're paying, or what companies paying for AI talent, is that indicative of an AI bubble like Sam Altman talks about?
It can be a bit crazy. I think when you look at any of these cycles, there's always, the hype cycle and then sort of the reality, and things settle down. So we're probably in the hype cycle before we get to the trough of disillusionment, right? But that being said, there's so much good that's coming out of it. And I think whether you're using it internally to drive efficiencies, or whether you're using a fleet of AI agents that have to be protected, there's opportunities and benefits, I think, long-term for the entire industry and the planet. So it's just getting through, like most things, they get hyped up, companies shake out, there's too many of them, and then you get down to the big winners, and I think we'll see that over time.
And real quick, we still welcome interns. Interns are fine, right? They're okay.
Interns are fine, but you wouldn't let them run loose in your network with admin access, right?
Fair enough. I just wanted to clear that up. Yeah, we dig interns. I used to be an intern.
That's kind of what an AI agent is, and that's why you need the guardrails around it.
All right, fair enough. CrowdStrike founder and CEO George Kurtz, always good to see you. Appreciate it.
You too, thank you.
All right, Jared, back to you.
Thank you, Brian. And we have all your market action ahead. Stay tuned. You're watching Market Catalyst.
In the late 1970s and early 1980s, America was on the ropes, facing high prices and high joblessness all at once. Then Paul Volcker, appointed in 1979 as Fed chair, took a sledgehammer to inflation, jacking rates toward 20%. By 1981, Ronald Reagan inherited an economy in crisis, but then came an unexpected moment. On August 17, 1982, Volcker and the Fed announced a 10% rate cut. That day marked the bottom for the markets and the birth of the most powerful bull market in U.S. history. Yahoo Finance Trader Talk host Kenny Polcari sat down with Jimmy Rutledge of the NYSE Board of Directors to connect the threads on what was felt and what it meant for markets.
When I came out as a broker, the average daily volume was 12 million shares a day.
12 million?
12 million.
Today we're trading 19 billion.
That's correct. And going into 1980, it had increased, but only to 45 million.
Right.
Which, compared to 12 million, is a lot.
It's a lot.
But it was an odd lot, so to speak,
Right.
as we continue to progress. And we started going into Volcker, et cetera, it started rising, and it rose very quickly.
Right. But wait, before we get to Volcker, let's just talk about the end of the Carter years, what was happening in terms of, to your point, a taxi medallion in New York City cost more than a seat at the New York Stock Exchange because
Because you couldn't make a living down here.
couldn't make a living.
There was no activity.
Right.
And when there was activity, it was inconsequential.
Right.
In addition to that, during that period, we went from fixed floor brokerage
Right.
and fixed rates,
Right.
which impacted. It was good, ultimately good because it increased volume.
Right.
And we started to come out of this
We went
malaise.
to negotiated rates, which is what went from fixed to negotiated.
That's
and
correct,
that's
yeah.
what lit the fuel.
Yeah. So going into 80, we were still doing nothing. We weren't making a living, but things were getting better.
Right.
And then the market exploded in
Right.
82, and it was happy days are here again.
Right.
And it continued right up until.
Right. So I was in college in 1980, 81, 82, and I had the opportunity to come and work here as an intern on the floor. You know, you ran, right? You were a gopher. But that's okay. I'd never had any exposure here, and so I came here. I learned about the business. I was here in 80 when it was really dead.
Yeah.
81, I was making $500 a week with Doug McQuaid. I was making $500 a week in 1981. In 1982, when I came back, it was at the depths of the economic malaise. It was horrible. And Doug McQuaid, who was an independent broker, said to me, "I can't afford the $500 a week to have you." I thought to myself, wow, okay, maybe this is the summer I'm going to be a lifeguard on the beach. And that's when I ran into Billy Latham.
You would have drowned.
Yeah,
So
yeah.
that's good miss.
I ran into Latham, who was actually doing a bunch of option-related layoff business. That was kind of the core of his business. He put his arm around me and he said to me, "Hey, kid, you know the symbol for IBM?" I go, "Yes, sir, it's IBM."
You're hired.
He goes, "You know the difference from an eighth and a quarter?" I said, "Yeah, it's 12 and a half cents." He said, "Great, when can you start?" I go, "Now." He said to me, "How's $1,000 a week?" I was like, "What?"
Jeez.
It was great. He was unbelievable. But anyway, in 1982, the summer as we moved into the summer, there was nothing happening here, right? Rates again were 20%.
That's right. Yeah, you could throw a bowling ball down this place and not hit anybody.
Yeah.
But I will tell you, I started to transition my business as an independent, and I was doing business for a specialist in Chicago,
Right.
who was doing layoff business here and doing options and futures.
Right.
So that was a whole new exposure
Right.
for me.
Right.
And it bailed me out.
And it built out a lot of guys, by
Yes.
the way, right? It built out a lot of guys. But so let's talk about as we led up to August 17th. It was in the middle of summer. It was this August doldrums, all that stuff. And there was a word, because there was no TV, there was no internet, there was no radio. The only way we got information downstairs was we read the newspaper or somebody from upstairs called
us. That's right.
to tell us what was happening.
Yeah.
And so on Tuesday morning, the Fed came out with that surprise announcement, because it was a surprise on that day.
Certainly a surprise to me.
And at 8:30, it was about 8:30 and 30 seconds, every phone rang. Do you remember it? It was like Christmas.
Yep. And I can remember I had two clerks at that time, and both of them they got buried.
Right.
And I was doing what was called $2 business
Right.
for Solomon Brothers,
Right.
which was right around the corner from my booth. And they were buried because they were not only getting the traditional orders, but they were getting program orders, which none of us knew about.
Knew what they were. It was a new phenomenon.
Exactly. And it was total pandemonium until the close, and then some.
Right. But so explain the kind of orders you were getting. When the phone rang, the upstairs trader was giving you what kind of orders?
Basically, buy 1 million shares and don't come back until I own them.
Until you own them.
And then when you come back and say, okay, you bought 100,000 at a quarter or 100,000 at 3/8. I was a particularly good broker, so I bought some at an eighth.
At every fraction. Every fraction.
There you go. And the guy would take the reports, not even question the reports.
Right.
Take another million to buy.
But everybody, every broker, because I was in the booth as a clerk. Every time the phone rang, I'd pick it up and somebody would scream another buy order at me.
Yeah.
Every broker, no one was getting sell orders. Everyone was getting buy orders.
That's right.
And so the market ran, I'll never forget it, 35 points on the Dow. That was 4.5%, which was a big move.
That's right. Yeah.
Right?
Yeah.
And everybody
yeah.
was stunned. We were all like, what?
It was a move that I had never seen before. Right. And as I recall, when we came in the next day, we expected the same kind of activity. Right. It was busy as hell, but nowhere near what it was. And we were so surprised.
Right.
Now we were anticipatory, if you will.
Right, but while it started to slow, it remained elevated for a while.
Oh, yeah.
And the market remained very robust going into the fall that year.
Yeah. And the fall was pretty busy as well.
Right.
But a hell of a lot more calm.
But calmer, but still busy.
Oh, yeah.
Right? It still had that excitement to it, right? I mean, it was exciting every day, no matter which day. It was just exciting, whatever the news was, to create the action on the floor, because the action was really...
It was the best job on the planet.
The best job on the planet.
Couldn't wait to come to work.
Yeah.
Not a lot of people got to say that, but it was the best. I'm here 57 years, and I still like coming to this place.
So do I.
Trane Technologies ringing the opening bell at the NYSE today, marking 5 years since its launch. Trane builds the climate systems that keep buildings, factories, trucks, and data centers efficiently cooled or heated. And it's on Time's list of most sustainable companies for 2025. And with me right now is David Regnery, Trane Technologies CEO. Dave, thank you for joining us here today. Looks like a lot of fun down there at the New York Stock Exchange. I want to ask, 5 years, you rewind the clock, and I was pegging the beginning of this at about March of 2020, a very auspicious time to kind of launch a new venture. What did you learn over the pandemic, and then how did you make it work? I'm noting that your stock is up about 330% from those pandemic lows.
Yeah, well, first of all, thanks for having me on your show. Glad to be back. Look, we just rang the opening bell. You showed the clip. It's always exciting at the New York Stock Exchange. First of all, just because there's so much history there that you can just absorb as you walk through the halls. Yes. But I was giving an opening presentation to our investors and many of our employees, and we were talking about where were we 5 years ago. And you think about it, 5 years ago, our revenue was $12.5 billion. Our stock price was under $100, just under $100. Our market cap was like $35 billion. We had 35,000 employees. And then you look today, 5 years later, and 5 years, it sounds like a long time, but it's really a short time. Mm-hmm. I mean, here it is, 46,000 employees. Our revenue this year will be about over 21 billion. Our market cap now is over 90 billion. Our stock price is over $400. And it's been a great ride, but what I told our employees was, look, we've had a great ride over the last 5 years, and we should all be very proud of that. I'm certainly proud of that as the CEO. But I would tell you that the future is very bright, and our best days are yet to come as Trane Technologies.
I like to think that as well. I'm an optimist here. I want to ask you about AI and how your company fits into that trade. Data centers, they generate a lot of heat, and you are in the HVAC, which includes the cooling business. How do you fit into this AI trade, which as utilities have seen tremendous interest from investors recently?
Yeah, I mean, first of all, we've been strong in the data center vertical for decades, okay, not just the last 2 years. And yes, they do generate a lot of heat, and we remove a lot of heat from these data centers. We work very closely with the hyperscalers. They're in our labs a lot, talking about what's next. And in the data center vertical, technology moves very, very fast. So solutions we had just 3 years ago have now changed, and we're constantly inventing better ways of cooling, better ways of making sure that the data center can operate very efficiently. So we love the data center vertical, but we're also very, very strong in all of our verticals. We track like 14 different verticals. And during the second quarter, we had strong results in the majority of our verticals. So where a lot of companies are just running after data centers, we've been there. Okay, we're strong today. We'll be very strong in the future. Look at the core markets too, and that's that we're very focused on that as well. And with our direct sales force, we're able to really capitalize on that.
Thinking ahead throughout the end of the year, 2025, even next year, what are some of the key risks and opportunities that you're seeing?
Look, I think that, we always talk about our culture at Trane Technologies and how we don't like to think about problems, we like to solve problems, right? So we're always a little bit more optimistic than many companies are. But obviously, we're coming over the tariffs, okay, understanding the impact there. We're trying to mitigate that. I think I was talking to up in Washington, and we're the model company, right? We've had, we're in region for region, right? We're the company that the administration is really looking for. We manufacture in the region in which we sell our products on a global basis. We've created over that 5-year period, we created over 3,600 jobs right here in the United States. So, look, we think that it'll be short term as far as how we get through it. People will start to understand it. It's more importantly about what the future looks like. And we have such great solutions where we're able to save our customers a lot of dollars, okay? And that's because most buildings operate very inefficiently, about 30% inefficiently. And we're able to help them reduce that significantly. So you think about it, we have great paybacks for our products, and it has a reduction in carbon footprint.
We got about 30 seconds left. Any final words here for your investors?
My investors, I would tell you that Trane Technologies, our best days are in front of us. And yeah, we've had a great run for the last 5 years, but I'm very, very confident in our future. And we have such great solutions, such great innovation as Trane Technologies that I'll be back in 5 years, and hopefully we have the same accretion that we've seen in the past.
All right, we'll save a seat for you right here. Thank you for that.
Sounds good.
Appreciate
Thanks for having
that,
me on
Dave.
the show.
You bet. And coming up, we got full market coverage ahead in the second hour of Market Catalyst. Do not go anywhere. Coming up on this hour of Market Catalyst, first up, U.S. payrolls revised lower according to new data. We break down the health of the U.S. economy. Plus, will the meme stock frenzy reignite after GameStop earnings? We'll discuss, and we push ahead to Apple's awe-dropping event and break down what it means for the stock. We got 90 minutes into the trading day, and I am Jared Blickery. Let's get a check of the markets right now. Relatively quiet today, and we see a mixed market right now. The Dow is up about 10 basis points, or 47 points. S&P 500 down. We're going to call that flat right there, and the Nasdaq Composite just slightly in the red. And according to Polymarket, odds of a U.S. government shutdown are rising as a deeply divided Congress needs to pass a funding bill by September 30th. My next guest says there are several risks to U.S. growth that investors should be watching as the year continues. I want to bring in now Sozzi Shaith, Moody's Ratings Chief Credit Officer. Sozzi, thank you for joining us here today. Let's talk about this government shutdown. We've seen this movie before. It tends to happen a few times per year. Last time was in March. The can was kicked, and now we're facing the day of reckoning. Kind of lay out the possibilities for us, please.
Well, your graph before told you what the possibilities are, and maybe bringing it to what does that mean for the economy and credit markets, which is what we follow. And as you've said, Jared, I think markets sort of price in these possibilities, and you're not seeing much movement either in the Treasury market or sort of other financial indicators specifically related to the government shutdown, because, I think we all believe that this is going to be something that perhaps will happen. If it does, it will be short-lived. And in previous years, it hasn't had a major economic impact. I should say, however, this is the year that we've seen a lot of federal layoffs already in Washington, D.C. So at the local economy level, you might see a little bit more of a sort of impact than you might have seen in previous years.
And if the worst comes to pass, if we have a shutdown for a period of time, what are some of the specific sectors or industries that could get hit the first and then the hardest?
Sure. The first is those that rely directly on government payments that are sort of now in play once the government shuts down. Again, that could go your muni sector, your state sector, government contractors, vendors, and so forth. So that's sort of the first level impact. The second level is actually, if this shutdown leads to broader changes in government policy, specifically cuts that are longer lasting, that can then have an impact on the local economy in DC. And, the local economy in DC is your street carts, your retail, your restaurants, and so forth. But I think the big picture, sort of the bigger reliance on government spending, things like defense and things like that, I'm not sure that those will be affected by things like a shutdown.
All right, I want to shift gears slightly. We had the Bureau of Labor Statistics releasing its annual benchmark update or revision this morning, and Street had been expecting a downward revision of 682,000 jobs for the year. The 12 months ended March of this year, so it's a little bit rearward looking here. And we actually got 911,000, so it was a little bit worse than feared. There wasn't a huge market reaction, but let's face it, this is something that's kind of wonky, and the fact that we're talking about it at all today is because of the heightened attention on the BLS. The chief was just fired recently by President Trump, and there's a lot of controversy about data collection. So what is your take, and what do these numbers mean for us?
Sure. The take on the weakening in the economy and the labor market specifically, I think that is a true phenomenon. That is a trend that we've been observing in other indicators as well. So particularly if you sort of split the consumer by income levels, for instance, we have been seeing that at the lower income levels, consumption has been slowing. We've been seeing delinquencies rise in consumer credit. So that tells you that the job market is not as solid as maybe the previous numbers had led us to believe. So that's one thing. And even the previous numbers, even when they were unrevised, they were telling a story of a slowdown. So I think that's the biggest takeaway, that the economy is indeed slowing down. On data and revisions, again, I think many people have many views. Mm-hmm. This is data that is always subject to revisions. So this is not something that's particularly new. The scale of the revisions, yes, remarkable, but this has happened before as well.
And before I let you go here, we have CPI to be released in a few days, and that's the inflation part. We've been talking about labor here. But what are your expectations for that, and then maybe expectations for the Fed next week?
Sure. We don't forecast monthly, but I will tell you that we're expecting inflation to be around the 3% range for the year as a whole. There are risks on the upside to inflation coming from tariffs particularly, but our view is that the Fed will cut next week, and that's because of our view that the economy is slowing down. You're seeing that in the labor market, you're seeing that in consumption trends. So even if the inflation number comes out slightly above expectations, our belief is that the Fed will cut.
All right, very insightful. Really appreciate your time here. Thank you, Otzi.
Thanks for having me.
And coming up, an investor playbook for the video game sector. Shares of gaming giant Take-Two Interactive, maker of the hotly anticipated Grand Theft Auto 6, are up over 30% year-to-date, hitting a new intraday high. Meanwhile, GameStop, one of the earliest examples of a meme stock, has lagged and is shifting away from games and is into crypto now. We're going to see if that strategy pays off when the company reports earnings after the bell. For more on how to navigate the video gaming sector, we have Michael Pachter. He's a Wedbush Managing Director of Strategic Planning. Michael, really happy to have you here. Let's start with GameStop after the bell. We know they've made this pivot into a Bitcoin or crypto treasury company. That was about in March of this year, and we've seen pivots before. Do you think what kind of details can we expect? Because they have not been famous for disclosing much on their earnings calls.
Oh, a quarter ago, they told us that they'd bought about 500 million, 600 million of Bitcoin. So I expect it will get a number about the same this time. And they have about 6 billion in cash. So, they're very slowly acquiring Bitcoin. It's possible they're buying more. The problem with that strategy is that the companies that are engaged in it, most notorious is MicroStrategy, are trading at about 1.75 times their Bitcoin holdings, and GameStop's already trading at that level times its cash. So it's highly unlikely that if they convert cash to Bitcoin that they're going to appreciate further. This is really a pretty bad story. It's a company going bankrupt that's taken advantage of its retail shareholder base to raise capital. They're going to pivot to Bitcoin, which maybe preserves the value, but I don't see any real upside there.
All right, thank you for that. I want to shift gears to a discussion of hardware versus intellectual property. And just thinking about over the next 12 months, if you had to pick one bucket, and one of those could be chips and hardware with maybe NVIDIA, Microsoft, Sony consoles, and then you have content and IP in the other with Take-Two and Roblox, and we'll get to Grand Theft in a second. Where do you see that heading over the next year?
I mean, the hardware side's hard to play. NVIDIA obviously is a phenomenal company, but a very small percentage, I think less than 5% of their revenue comes from gaming. So it might be 10, but it's really small. I think it's 4 or 5 billion a quarter out of 45 billion. So, they're great. But they're not going to really grow that very much. They used to be more like 50% gaming for PC graphic processors. Now it's all AI. So I love NVIDIA, but it's really not a gaming play. Nintendo is the pure play. Sony is not quite pure play because of studios and other things. But Nintendo is a pure play hardware manufacturer that also happens to have a lot of great software. And you can participate there. The stock's at an all-time high. So, it's fine. I think that there probably is some upside there, but I much, much prefer to play in the software side. Intellectual property is inexpensive to reproduce again and again and again, very high margins. So you want to play the guys that have the content or the guys that have the technology, and that would include Unity and AppLovin.
All right, let's stick with content and IP, talk about Grand Theft Auto 6. It's been a dozen years since 5 came out, and I'm wondering what the expectations are, and then the pricing point especially. I believe you've said it could reach triple digits.
Yeah, I'm pretty confident it will be $100. And it's funny because I'm basing my guess on what the CEO Strauss-Zelnick has said, which is that they're going to charge what they believe that the game is worth, and consumers will feel that they got a value for what they're paying. No point in making that comment if you're going to charge 60 or 70 bucks. So just the idea that he's addressed price tells me it's going to start at 100, and I don't think gamers are going to even flinch. This game is going to be probably twice as big as the last one. As you pointed out, 12 years in development. It'll come out just shy of the 13th anniversary of the last release. They have 1,200 people working on it, which means they're spending way north of 100 million per year on development costs. So they've got $1 billion, $1.5 billion invested in the game. Why not charge $100? And the truth is, gamers are an entitled bunch of whiny little babies. But the truth, they can wait a year if they don't want to pay $100. They can buy it at 70 next year. And I think Take-Two will charge 100. I think they will sell 30 or 40 or 50 million units at $100. And that incremental $30 is virtually all profit. So if they can make an extra $2 or $3 billion, why not?
I want to ask you, we're heading into the holidays already. Any expectations? Where do you see the opportunities?
Well, the tariffs are a mess, and our Orangeman as president, I wore this in his honor. He doesn't seem to understand that his tariff powers are being illegally applied. We'll see if the Supreme Court remains in his pocket or not. But tariffs on consoles is a bad thing, and we've already seen Sony and Microsoft raise price. Nintendo's going to have to raise price. That doesn't happen, has never happened. Consoles drop in price over time. So, I think that's going to dampen demand. The good news is that we've gotten cloud gaming to the point where you could actually deliver a game purely from the cloud, so just to a TV with an internet connection. And we obviously already do that with mobile games. So consoles are going to be less important, but they're very important this holiday. Sony's not going to sell very many. Microsoft's going to sell fewer. Nintendo with the new Switch 2 is going to sell a lot. So they'll be okay. But I would not be focused on hardware console makers. I'd be focused on the software guys who can make money in a bunch of different ways.
We got under a minute here, and I'll give you the floor. Anything we didn't cover, anything you want to say?
Yeah, I think that if you look at the gaming names, all the good ones, EA, Take-Two, Unity, AppLovin, Roblox, Nintendo are all at one-year highs or higher, or all-time highs. The one that's lagging, and I own it, so I'm full disclosure, I'm talking my book, is Playtika. They're at a couple of year low, and I think that one is fascinating. I own a lot of it because I really believe in it, so I'm talking my book. But that stock's trading at a very low single-digit multiple, and I think they're going to participate as the gaming names continue to draft higher. So I think that's the one you can make a 4 or 5 bagger, and I would look at that one hard.
All right. Appreciate all your insights here. Learned a lot. Thank you, Michael.
Pleasure.
And all your markets action is ahead. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We are live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and what we're seeing across all three major indices is a bit of a mixed picture here. Right now, we have the Dow leading the upward momentum, up nearly 0.2%, but the NASDAQ largely moving down. As you could see there, after that jobs revision showed that nearly 1 million jobs were lost over the past 12 months, and the S&P 500 roughly flat, also moving lower based upon or following that jobs revision that we got. But once again, the Dow holding on to the momentum after a bit of a dip at 10 a.m. We are seeing upward momentum. Let's take a closer look at what exactly is driving that. If you take a look at the Dow heat map on the YF Interactive, right now we have JP Morgan as well as Chevron leading the Dow, moving higher. We also have Visa up about 0.7%. That's certainly leading the action here. Goldman Sachs also moving the Dow higher, up more than 2.5%. And also moving the most, we have United Healthcare, that stock up nearly 5% in intraday trading here. Of course, the NASDAQ did close at record highs on Monday after all three major indices closed lower on Friday. But right now, we're seeing a bit of a mixed picture here. If you take a look at equal weight, what exactly is leading the momentum here is stock team up about 4.3%. We also have Palantir holding on to some momentum, up about 1.5%, and Meta holding on to some gains as well, up more than 1%. And largely what we're seeing here is energy continuing to lead this momentum in early innings of today's trading session. And in the laggards, we do have materials moving lower, down more than 1.5%. Once again, though, mixed picture here on Wall Street. We have the Dow holding on to some momentum, up about 0.2%, and the NASDAQ and S&P 500 roughly flat as we make our way into today's trading session. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching Cracker Barrel, Eli Lilly, and Wolfspeed. First up, Cracker Barrel. Amid widespread backlash to the company's logo relaunch, the restaurant chain also announcing it's halting plans to renovate restaurants. Brooke, it seems like sometimes people do not like change. Another rollback, what do we know?
Yeah, well, right now, the company putting out a statement that said if your restaurant hasn't been remodeled, you don't need to worry, it won't be. And this largely comes after that this huge chaos that was surrounding Cracker Barrel over the past month after the company unveiled a new logo that then got pushback from all sorts of ways, not only from consumers but also from President Trump. And then we saw the company reverse that new logo and stick to the older logo that features the barrel and that Uncle Hirsch skull. And then on top of that, this was really supposed to be an investment year for Cracker Barrel. The stock over the past year is up more than 40% as the company said they were making major investments. The CEO, Julie Fast-Machino, said that this was going to be an investment year for the company. But largely, we've seen this, turbulence in the stock price as the company sort of tries to understand where exactly it is with wanting to gauge and meet new, younger consumers, but also want to introduce these new innovation, type of more forward models in their restaurants. We do know that 4 locations do have that new store design. That's out of 660 locations. Once again, that won't be changed. The company has since suspended that redesign after all this noise.
Yeah, tough balancing act there for the company. Next, we got to talk about Eli Lilly. Bank of America sees a win for the stock after the Institute for Clinical and Economic Review released an updated draft report, which now views obesity drugs as cost effective at current prices. And Brooke, Eli Lilly was a stock, I believe it peaked about a year ago, couldn't crack $1,000. Now it's off about 25%. Does this move the needle for them?
Yeah, well, the 52-week high was 942.35 cents. That's according to the Yahoo Finance data. The analysts on the street saying that this represents an important step towards securing better employer and payer coverage, which has since slowed down. Of course, this is a larger discussion as the administration really tries to push reducing drug prices. We know that Eli Lilly is looking at a direct-to-consumer model, Lilly Direct, but this stock has surged in the past month. It is up about nearly 20%, and that's largely driven by strong earnings expectations. We saw some positive trial results, but right now, this latest announcement that it's getting a vote of confidence on really the reduced costing around obesity drugs is certainly getting investors excited about what exactly this can mean for accessibility. Once again, though, the stock is still largely down from that 52-week high, now about $750.
Thank you. And finally, Wolfspeed. The semiconductor company said its reorganization plan has been confirmed. This clears a way to emerge from bankruptcy within weeks. And Brooke, this is a stock that was $140 a few years ago, and now we're talking about $1.78. So very impressive gain today, but bankruptcy and that critical emergence is kind of in investors' minds.
Yeah, absolutely. When you look at this stock, it's up nearly 45% today alone. But the 52-week high was about $17.45. And as you just noted, it is largely down from where it was just a few weeks ago, or just a few years ago, rather. But the CEO once again saying that this clears the path for us to complete our restructuring process in the few weeks. They went on to say that they look forward to emerging with the financial flexibility to move swiftly on strategic priorities and reinforce our leadership in silicon carbide. Now, this company does make chips using that silicon carbide. They also, those are sort of used in these high power conversion models. Think EVs, think solar inverters, and also those industrial power systems. And so largely this stock is really rallying on the possibility for this company to really take advantage of the current market and the current need of supply within it.
All right, really appreciate that, Brooke. And you at home can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. And week one of the NFL season is just about in the books, and that has gaming companies looking to capitalize. Yahoo Finance's Josh Lipton spoke to the CEO of BetMGM about the evolving landscape for sports betting. Let's take a listen.
BetMGM is healthier than it's ever been. Our product is in the best shape that it's ever been. We've got a ton of new product features coming. Happy to dive into any element of this. And so if you like BetMGM before, there's no better time to be a BetMGM customer than right now. And it's across the board. We have a brand new brand campaign, and the essence of it, in fact, that's a great place to start. The essence of it is BetMGM, and this is the platform of our new brand campaign, makes the ordinary extraordinary. It makes watching a game that you love even more extraordinary. And that's all the way through the business. We do that for our players. We do that for our colleagues. So yeah, there's lots of reasons.
Are there new features, Adam, new experiences that I'm gonna enjoy this season?
Absolutely, Josh. Look, the app itself, we've worked very hard at making the app as fast and friction-free as possible. And so one of the things you'll see new this season at BetMGM, we're introducing live same-game parlay offering for the NFL, which means that our players will be able to continue to build same-game parlays before and during the game and cash out all of those during the game. We've also delivered what the headline is betting insights. So it's insights into team and players that are integrated right into the app. So you can build confidence and conviction around your opinion without ever leaving the app. We've also rolled out sleek dark mode. We have a new rewards integration, new ways of building parlays. There's a lot to be excited about, Josh.
You know, Adam, let's talk about the macro for a second, because every day on the show we talk about the economy, and there are concerns, Adam, about a possible slowdown, about the Trump tariffs. I'm just curious whether that has shown up. Has that bubbled up in your business, Adam, at all in terms of betting sizes or behaviors or patterns?
Well, that's so. The short answer is our players are very excited that the NFL is back, and they have come back in record numbers. And I'll come back to the specifics in a moment. Last night's game, Bills-Ravens, was the most handle we have taken on any single NFL game ever. And second was the season opener on Thursday. And so then breaking it down on a player level, to answer your macros question, we're seeing players come back more often than they did last season. Average bet size is remarkably consistent, so no pressure on average bet size. Number of bets per session, per player, per week, really consistent, and in fact, increasing. So we're seeing on ground level, at a player level, we're seeing no impact really of what is a challenging external environment.
What about, Adam, the iGaming business? So folks playing slots on their phones, what are the trends there?
Well, you may recall that at BetMGM, our iGaming business represents 2/3 of our revenue. And in the first half, we grew at almost 30% year on year. We're seeing that business just charging. And in fact, we've had the last few days, as the season has started, we've seen record numbers of players come out into our iGaming business, of course, helped by the fact that on an average week, about 60% of our sports players also go and check out the iGaming offering that we have, which is first class.
Adam, are you still intending to expand into new jurisdictions this year?
So that's we're excited. We're on countdown. We're going to see our next the next sports betting jurisdiction, which is the state of Missouri. We're on countdown. We're 70 days away of pre-registration. That market starts. You can make your first bet on December 1st. We will be there on day one. You can bet your bottom dollar on that. And as we look into 2026, we're particularly excited about the launch of the province of Alberta, north of our border, because that's both a sports betting and an iGaming jurisdiction.
Adam,
mid-26.
Always great to have you on the program. Thank you so much for joining us. Big picture, Ed, you see this number of crypto firms taking a public market plunge, and especially, Ed, this activity around crypto exchanges. And I'm wondering what explains that trend, Ed. You know, is that, hey, listen, if you're in crypto, you got a friend in the White House? Is it the regulatory changes? What explains this theme?
Yeah, absolutely. So, I mean, as of today, one of the core drivers of crypto activity is trading. And a lot of that is from Bitcoin trading and increasingly more altcoin trading. So I'd say the fastest way that traditional non-decentralized companies have monetized this is via crypto exchanges. And we're seeing that where some of the biggest crypto companies in the world do end up being crypto exchanges, whether they're Coinbase, Binance, or emerging entrants such as Bullish.
All right, let's talk about Bullish, Ed, because I believe you got a neutral on that one, Ed. So you're on the sidelines. Is that, you know, in broad strokes, is that because, you know, you just see risk reward balance here at current valuation?
Yeah, absolutely. So we think it's a phenomenal company. It's got a phenomenal opportunity, not just globally, but also the US. I think the one thing that keeps us on the sideline is we're a little bit unsure of how they do get into the US market. So currently they're operating in regulated jurisdictions outside the US. As you know, the US regulatory environment has been not the most hospitable over the past couple of years, but Bullish is seeking to have a license. I think the problem, though, is in the meantime, until we get some broad-based crypto regulation, such as the Clarity Act, there's no direct path for a crypto company to get regulated in the US today. And so we're a little bit cautious on them getting into the US without kind of a formal regulatory framework. And we don't expect that to happen really until sometime next year. So I think the very near term, we have a hard time seeing them get into the US in 2025. And then potentially there's an opportunity next year. But we'd like to see a little bit more clarity on the US regulatory side before getting a bit more confident in Bullish here.
Can I also ask you, Ed, just when you look at the competitive landscape, what makes them different? What is their advantage versus, you know, a Binance or a Coinbase?
Mm-hmm. Yeah, so these guys compete in international markets, and international markets are much more competitive than in the U.S. The barriers to entry outside the U.S. are much lower, especially for some of these unregulated exchanges that have kind of dominated the industry in recent years. And so Bullish competes with these ginormous international exchanges like Binance, OKX, Bybit. And to do that, they've really had to compete on pricing. And so if they're able to compete on pricing in these extremely competitive international markets, we think that if they were to get in the US where things are a little bit less competitive, they could take some market share from Coinbase just by offering a better pricing and pretty favorable liquidity, especially versus some of the other US competitors.
Does it matter to you, Ed, as a financial analyst, to you or your clients, when you know you got a heavy hitter like a Peter Thiel behind a name like Bullish?
Yeah, absolutely. And then Bullish's CEO, Tom Farley, he's been on Wall Street for a while. He had a number of executive roles at NYSE Group and NICE. And I would say that definitely makes a difference for investors, especially in crypto, where a lot of the actors have a little bit more murky past. It's a little bit harder to kind of background check a lot of these other major players in the crypto industry. And just to have someone more kind of buttoned up and a bit more mainstream, I think does make investors a little bit more comfortable investing in some of these crypto companies.
It's interesting. Ed, all right, so you're neutral on Bullish. Let's get to a name you like. Robinhood in the news, surging today. It's going to be added to the S&P 500. It's up about 15% right now. You're a fan of this name, Ed?
Yeah, absolutely. So, I mean, they've been snubbed on the S&P inclusion for, we think, 1 to 2 quarters. So I think this was more of a matter of time rather than, so we shouldn't be too surprised by it. But in terms of just the U.S. regulatory environment improving, we don't see many companies that benefit more. So this company, they've got millions of users across the platform, not just trading crypto, but trading kind of everything, whether it's prediction markets, options, equities. And our view is that as the U.S. regulatory environment improves, these guys can monetize this existing user base better by offering more products and services that are now allowed in the U.S.
All right, so you got a buy on Robinhood, you got a neutral on Bullish. Let's go with a sell next here. You have a sell on Circle, Ed, which is interesting. I mean, listen, a lot of interest in stable coins, a lot of interest and excitement over maybe the adoption curve there, Ed. Is this call in part, you're not a believer in that adoption curve?
No, we're extremely bullish in stablecoin adoption. We're extremely bullish on blockchains disrupting the financial industry. I think for Circle is one of our issues is as these become mainstream, we have a hard time seeing 1 or 2 companies dominate an entire industry. And so especially I'd say this is a bit more middleware where yes, liquidity does matter, but in terms of the technology behind it, there's tons of different platforms out there that offer, I'd say, similar, maybe not as good technology, but still decent technology. And our view is that as more of these mainstream banks and fintech companies want to get involved, they can partner with maybe one of Circle's competitors and offer maybe almost as good service. And so it's more of a market share idea where we think that this industry is going to be a little bit more fragmented than it is today, where it's really just dominated by 2 players.
I want to squeeze one last one in here, Ed, if I can. Another name you cover, Michael Saylor's Strategy. That's also surfaced as a potential S&P 500 entrant. I'm just curious, what do you make of that, Ed, and why is this one still a buy in your opinion?
Absolutely, yes. So, I mean, we're long-term bulls on Bitcoin, especially here at Compass Point. We've been covering crypto for 5+ years. And for MicroStrategy, it's really still the best proxy to get exposure to Bitcoin. In terms of their S&P inclusion, they actually didn't quite qualify for S&P inclusion until last quarter when they actually reported their first full quarter of significant profits. A lot of that was change in accounting standards that actually just took effect for a lot of companies this year. And so our view is that, hey, if you want Bitcoin exposure, not only has this company, obviously, they track Bitcoin, just given that's a vast majority of the valuation, but they've found an ability to increase their Bitcoin per share in both bull, extreme kind of euphoric environments, and even in today, where they're not necessarily selling stock like most of the other crypto treasury companies. They're finding more creative ways to kind of finance this acquisition of more Bitcoin, which helps them kind of outperform, we think, Bitcoin, just given that they can increase their Bitcoin per share over time.
We're just about 1 hour away from Apple's biggest product launch of the year, where the company is expected to unveil the highly anticipated iPhone 17 and more. Joining me now is Michael Ng, Goldman Sachs Senior Equity Research Analyst. And thank you for joining us here, Michael. First, let's start with your outlook
Thank you so much for
the
having
event.
us.
What are you expecting?
Yeah, I think at the event we're going to get the announcements for the new iPhone 17. There are 4 models that are expected to be announced, and it's going to be the iPhone 17 base model, the iPhone 17 Pro, and the iPhone 17 Pro Max. What will be potentially new this year is the iPhone 17 Air, which is going to be a new, slimmer form factor and one of the more substantial form factors that we've seen in the last several years. In addition to the iPhone announcements, we'll get new products around the Apple Watch as well as new AirPods.
Well, and let's talk about the investors now. What might Apple say that would get investors a little bit excited about this announcement here? Because a lot of years it's been sell the news.
Sure. Yeah, I mean, there's a tremendous amount of focus on what iPhone revenue growth will look like in the next several years. And I would say the key debate in the market is what happens to the iPhone replacement cycle. And the way that we look at it is that new product innovation and demand drivers is what's going to shorten that replacement cycle, improve the upgrade rates. And some of the things that we're watching out for at the event is whether or not things like the iPhone 17 Air, the slim version, is going to be a product that resonates with customers. Similarly, when you think about what drives iPhone revenue growth, right, it's both units but also pricing. So what is the company going to do with pricing, just given some of the commodity cost inflations and other areas of cost inflation that they're seeing? I think there's an expectation that we may see I'll call it a de facto price increase on the iPhone 17 Pro, just as they remove the lowest storage option, the 128 gigabyte storage option, as one of the potential storage options on the iPhone 17 Pro.
And let's talk about services, which is an important flywheel for Apple keeping their revenues stable. Any expectations for what we might learn in the services arena?
So I don't think we're going to get any new announcements around services today, right? But I think there's a tremendous amount of focus on what happens to the iPhone install base and the implications for services. Services as a category, I think, is viewed as a very high quality, and frankly underappreciated revenue stream for Apple. It has showed consistent double-digit growth. The gross margins are accretive at mid 70% gross margins. And I think services, in terms of the growth outlook, looks a lot better now than it had earlier in the year. One of the big events that happened, big developments, was the clearing of the overhang related to the DOJ Google case. Google is obviously a big contributor to the services revenue for Apple through its payment for traffic acquisition costs to be the default search engine on Safari and other Apple-related assets.
All right, if I'm an Apple investor, what should I be watching over the next few days, maybe a week, as some early signals as to how this event was received? Should I be looking at wait times? Should I be looking at which colors are selling out? You tell me.
Well, I don't think that wait times and sellouts, right, are necessarily going to be the best leading indicator of what demand looks like. And the reason is because looking at wait times and sellouts is only one portion of the equation. It's very dependent on what channel inventory looks like. So there are a lot of things that can impact channel inventory beyond just end demand. If there was a single KPI that I'd be interested in monitoring, right, it would be consumer sell-through, right, and that's ultimately going to be the best measure of end demand and a leading indicator of what revenue will be in the future.
All right.
I was just going to say, I think seeing what you're going to, I think seeing the U.S. carrier promotions, right, and the promotions and the support that you get from the broader reseller channel is going to be incredibly important as well. Just as you think about other players in the ecosystem that are going to go and support iPhone demand.
All right, really appreciate your time here, Michael. And that's going to do it for Market Catalyst. I'm Jared Blickery. Thank you for watching. More Yahoo Finance ahead.